The African Growth and Opportunity Act, better known as AGOA, is an American law which is now 13 years old. It was originally designed to assist African states to export their products to the United States, quota and duty-free. At the moment, that law is under review. Delegates attending a high-level forum in the Ethiopian capital of Addis Ababa are evaluating AGOA's successes and bottlenecks so far and the terms of its extension, as CCTV's Girum Chala now explains.
The forum aims to boost U.S.-Africa trade ties and review the terms of the extension of the flagship AGOA agreement, which expires in 2015. African representatives stressed the significance of reforming AGOA at a time when the continent is experiencing unprecedented economic growth.
AGOA remains the central pillar of the U.S.-Africa Trade and Economic Organization and Cooperation. But due to severe supply-side constraints, its potential benefits were far from realized.
The U.S. government, on its part, believes the AGOA Act is important for creating jobs at home as well as supporting job creation for African states. In his recorded message, President Barack Obama emphasized his administration is ready to stand on Africa's side.
Africa is rising. And in our global economy, more growth and opportunity in Africa means more growth and opportunity for everyone. That's why I announced 2 new initiatives on my trip. Trade Africa, to increase trade among African countries, and Power Africa, to double access to electricity in sub-Saharan Africa.
There is now a plan of extending the AGOA Act for at least 20 years. But experts and actors of the private sector say there are measures which should be taken from the U.S. side to make sure African countries can get more benefits.
You need to expand the product coverage. There are a few products that the U.S. considers as sensitive products, and it is that actually one last 1% that is excluded from the benefits of AGOA that is likely to make a difference in an extended AGOA.
There are 39 AGOA-eligible countries in Africa. Of those, 15 are middle-income countries. The focus now is how to increase the exports from those 15, with the rest to make sure there is fair distribution of opportunity. It's what the American and African authorities will be working if this forum is to be judged as a success.
Many say Africa has not capitalized on the trade opportunities presented by AGOA. As competition intensifies for trade and investment deals on the continent, African countries have to deal with the long-standing issues like regional integration. Gurumjala, CCTV, Addis Ababa, Ethiopia.
Let's get some analysis for you now. Jane Giga is the Chief Executive of the Kenyan Flour Council. She's live in our studios here in the Kenyan capital, Nairobi, right about now. Mrs. Giga, thank you very much for your time this evening. Give us a rough sense of how important AGOA is as a trade deal to Kenya, for example. How many jobs does it support?
Well, America is one of our top 10 destinations where we are looking at about between 30 to 40,000 jobs that are provided through the exports of horticulture, but mainly in the textile sector.
Right, but looking at the list of the top 5 beneficiaries of AGOA, we're looking at Nigeria, Angola, South Africa, Chad and Gabon. And the common denominator among all these is they're all hard commodity exporters. On that basis alone, can AGOA really be described as a success?
I think for Kenya we need to look at the potential that is available to us through value addition and of course through the expanded list of exports that go into America. For instance, we can already access in terms of horticultural products, but it means that we have to work on value addition.
Indeed, but you have of course been dealing quite extensively with the EU when it comes to sanitary and phytosanitary standards. Are those a big problem in the United States as they are with the European Union?
From the experience that we have of our own phytosanitary institution, KEFIS, and that of the states, it is not a big problem. It's not insurmountable. And as we speak now, we already have access for some of our horticultural products, specifically the pre-processed vegetables and vegetables like baby carrots, shelled peas, and even French beans. So we already have access for these products. Fortunately for the flowers, we don't really need to go through the rigorous risk analysis that we had to with the other vegetables.
Indeed. Thank you very much for those insights. That's CCTV's, that's rather Mrs. Jane Giga, the Chief Executive Officer of the Kenyan Flower Council, right here in our studios, giving us a bit more insight into exactly how important AGOA is with relation to the Kenyan economy and, of course, a couple others in the region. Now, CCTV's Gurum Chala also sat down with the African Union Commissioner of Trade and Industry, Fatma Haram, to take stock of AGOA. Here's some excerpts from that interview.
Thank you, Madam Commissioner. Since 2000, the government of the United States of America has introduced this AGOA Act to help African countries, particularly, to export items to the U.S. market. How is this act helping in being successful in Africa so far?
The last one on Africa's ground before the expiry of the AGOA, which is set for September 30th, 2015. So this AGOA is of strategic importance because that we're looking for an extension. One thing that we want to say is AGOA is a privilege whereby America has provided duty-free, quota-free for African product to penetrate the American market. Certain of our countries, such as Nigeria, Ethiopia, Lesotho, for example, for the textile and so forth, have benefited greatly from the AGOA. And then obviously we have seen a creation of jobs in these countries, growth and so forth. But we have to say that some of our countries have not benefited at all from AGOA.
Much of the attention has been concentrated on few items such as oil. And also many of African states which are part of this AGOA Act were not benefiting from this. So what do you think about this?
Yes, we know that exports have grew tremendously, from to the U.S. However, if you look at the figure, 90% or above 90% is really oil. I mean, we're talking about oils, which require heavy investment and so forth, and only certain countries have been, benefiting from that. But I think that when you look at the oil export, even without the AGOA, our countries will still export, this. So I think that the margin is very low. I mean, less than 10%. That is really, manufacturing kind of type of export, and we want to make sure that we increase it. But really, for Africa to benefit from this export, there are some prerequisites that we need help with. First of all, we have to produce what the market demands. That's the first thing. The second thing is also the quality, the standard, all these SPS type of standard and norm that the American market require or other competition market require. We need to respect the market specification and so forth. So I think that we need help in a way that how we can make sure that we comply to the specific requirement, the SPS and so forth.
Final question. There is a plan of extension, as you've been saying, that this AGOA Act might be extended to the coming 20 or 30 years. How is the African Union working towards making sure that African states are going to benefit from this act, not the other way around?
For example, sometimes the eligibility of the countries are set in a unilateral way by the United States of America. For example, if a country is eligible for AGOA, and then if for some reason there is a problem in this country, and then the privilege of AGOA is taken away. And I think that this is very difficult because, at the end of the day, you're not blaming the government, you're blaming the investors. And I think that this is also something that if there is a way of discussing it will be very, very good, so that the investor will feel will feel that the environment is good to attract investor, whether the country is politically stable or not.
Now, you have, of course, heard the African perspective, at least as far as AGOA is concerned. But what about the American one? Let's find out. CCTV's Nick Harper joins us now live on the line from New York. Nick, last year, American imports from sub-Saharan economies were down 33%. And the bulk of that decline came from the fact that the United States is now more reliant on oil. And that's a long-term trend. How will that in turn affect trade links with sub-Saharan economies?
Well, absolutely. This is the big problem that Africa and America, to some part, needs to work out. We have to bear in mind that America has had about $50 billion worth of African imports in the last 12 months. Most of that, about 87%, coming from oil-related products, much of it coming from Nigeria and Angola. So they need to try and work out a way to get non-oil products. That's something that the African unions have been looking at for some time. It has increased over the last 10 years. They have managed to find other non-related products that are not oil or petroleum based. That's increased by about 300%. But both African officials and the US need to look at this. For example, President Obama came to Africa just a few months ago, back in June, and a lot of that was to do with the fact that he wanted to try and create better trade links between various countries, to try and work out better ways that America can deal with Africa. So it is a problem that they're looking into, but they need to find out exactly which type of products will work best to import into America and try and move away from these petroleum-based products.
Let's talk about another trade deal. The EU has been pretty aggressive in Africa, chasing EPAs, economic partnership agreements, or to essentially give its goods duty-free access to the African market, which theoretically puts American goods at a competitive disadvantage. Now, are American policymakers seeking to have the same preferential access to Africa?
Well, there's been no obvious noises as of yet from America. At this stage, America is exporting about $22 billion worth of goods each year into Africa. It's a lot of money, but they are importing a lot more here to America. So it's something that they need to look into, but they need to look into it very carefully, because they don't want to be left behind by Europe, but at the same time, they don't want to be putting American businesses out of business by creating preferential rates, preferential treatment to African companies. So it's something that they need to look into, and they need to be very much aware of agricultural producers here in the US. People who are producing things like cotton, citrus fruit, peanuts. They could be put out of business if they give too much preferential treatment to African countries. So America will perhaps want to look into it. They want to be able to create better, stronger links with African trade countries, but at the same time they need to be very careful they don't put their own exporters here in the US out of business.
Indeed, thank you very much for that. That's CCTV's Nick Harper over in New York. We should of course point out that with respect to the volumes that we've just been talking about of American imports and exports to Africa, roughly 1.5–2 percentage points of the total exports and imports respectively around the world. Small fish in a very big pond indeed. Let's move on to some other place on the continent. Kenya Airways, the Kenya flag carrier, is now operating at 75% capacity following the partial reopening of the Jomo Kenyatta International Airport here in Nairobi. The airline estimates it may have lost up to $4 million in revenue following the shutdown of operations following a fire last week Wednesday, which gutted the airport's international arrivals and departure terminal. CCTV's Peter Akaba spoke with this airline CEO, Titus Naikuni, about disaster preparedness and what airport authorities have been doing to bring operations back to normal.
Disasters will happen, and the best thing is to prepare yourself to avoid them.
That is the reticent comment from the man charged with the running of the Kenya national carrier Kenya Airways, 5 days after the inferno that gutted the main terminal at East and Central Africa's largest and busiest airport. Slowly, the backlog in passengers and delays is clearing up. Airline CEO Dr. Titus Naikuni is on hand to personally supervise the loading and departure of this flight to Amsterdam from Nairobi, one of the first for the day. The airline, which uses the airport as a hub, is currently operating below full capacity internationally and expects to be fully operational once again by the end of the week, attributing the quick recovery to initial preparedness.
The reason we've been able to cope is because we have our own disaster management system, which kicked in immediately. That's why we were able to turn around everything. The second thing is to have a fallback position where we say, look, if this happens, then you do this.
Initial confusion at the airport meant that operations were hampered with flights grounded entirely, leading to losses in revenue estimated at about $4 million.
The first day there was confusion around the airport for all of us. I mean, you can imagine when such a thing happens. But within an hour or two, we'd realized the position we were in, and we had to take stock of where do we go from there.
This somewhat quick recovery has meant that those services were initially affected with delays in flights all over the globe. Operations have now resumed a semblance of normalcy.
If you look at the operations, we are now back international to about 75% of our plan, and domestic we are 100%. We believe we should be 100% international by Thursday morning or Wednesday night.
And though the airline says it has assigned large capacity aircraft to service areas with high traffic flows to even out the kinks in its operations, there may be little doubt that its business will continue to be affected as long as the recovery effort continues.
Operations almost fully back to normal here at Jomo Kenyatta International Airport in Nairobi, and conversations with companies that use this facility underscoring the fact that it is of utmost importance to have in place a comprehensive disaster management system at all times. Peter Wakaba, CCTV, Nairobi, Kenya.
The Nairobi Securities Exchange has signed a memorandum of understanding with the Shanghai Stock Exchange. It will essentially enhance the financial service industries in Kenya and in China. Speaking during that ceremony, the NCU CEO Peter Mwangi said the MOU outlines areas for future collaboration between the two bosses, and that includes training of human capital, tech and product development. The deal also covers mutual data sharing and quite a bit of joint research as well. The Nairobi Securities Exchange says the MOU is an important milestone and a key step in achieving its goal of being the leading securities exchange in Africa with global reach. Quarter to the top of the hour, we'll take a short break here on BizAfrica, but there's plenty more coming up. It's D-Day for Somali remittances as Barclays gets set to close down cash transfer accounts. Will be live in London and Mogadishu when we come back.
BizAsia. Asia means business.
Welcome back. The British multinational banking and financial services company Barclays says Monday may be the last day it will keep its doors open for small Somali-owned money transfer agencies. Increasing pressure from regulators and governments like the United States on money laundering and terror financing regulations has sent international banks fleeing from money transfer services, mainly out of concern that small money transfer companies simply don't have the tools in place to detect and prevent money laundering or the funding of terror outfits. And the flip side of that decision, however, is even more grim, with the potential to affect millions of Somalis who rely on remittances from overseas for their survival.
Dahabshil, the country's largest and most high-profile money transfer agency. It's among the 250 Somali-run money transfer agencies affected by the move. A global business, Dahabshil Bank provides cash transfer services to millions of Somalis through an informal system known as Hawala. Somalis abroad send money home via the Hawala money transfer agencies that readily accepts deposits abroad. And within hours, credit recipients, even the remote corners of this country. And for 2 decades now, millions of Somalis relied on such remittances for basic sustenance. Somalia's large diaspora community relies on the Hawala money transfer system to support families back home.
This closure will have adverse effects on operations of the Hawalas, and if the Hawalas fail, many people will have lost their lifeline.
An estimated 40% of Somali families rely on overseas remittances as their basic lifeline and could be grossly affected by the account closure.
This closure will affect us so much. It will affect the country's economy. Imagine this country without Hawala. Nothing would go on.
Our lives have been dependent on the Hawala. Many people will suffer if these accounts are closed.
Barclays, however, says it will close the accounts to tighten the noose on money laundering and unchecked funding of terror groups. Others fear the business could go underground into the hands of illegal providers. Mohammed Hirmoge, CCTV, Mogadishu.
Let's get some perspectives from the areas that, of course, are the flashpoints for this particular story. CCTV's Mohammed Hirmoge is in the Somali capital, Mogadishu, and Melanie Ralph is live in London. They both join us live. Hirmoge, let's start with you. Mid-August, broadly speaking, was the given time frame for the termination of services by Barclays. Has that happened? What's the situation in Somalia right now?
Roma, people here are sad at the prospect that this indeed might be the last month they're receiving remittances from abroad. And we know that 40% of Somali families rely on remittances from abroad. We also know that $1.2 billion annually is the figure that comes from abroad, from Somali keen abroad to help the people back here. And we know that figure is indeed more than what Somalia has received in foreign aid over the last 5 years combined. And people here say that it's a big blow for the country that has been reeling from a devastating 2 years of famine in the year 2011 and 2012. The Hawalas, as we know, have played a critical role in the livelihoods of millions of Somalis who have been solely dependent on remittances from their kin abroad. Therefore, the situation here is that of sadness.
Indeed. Melanie, I do know that Barclays has been presented a petition signed by about 25,000 plus individuals, including, of course, Mo Farah, the World Athletics champion, asking them to at least give these businesses much more time before they terminate services. What's the reaction of the bank to that petition?
Well, Rama, a petition like this with celebrity endorsements from the likes of the Olympic champion Mo Farah certainly raises the profile of the issue. It bumps the story from the back pages to the front, which can't help but make the powers that be sit up and listen. But that doesn't necessarily mean we're going to see a dramatic U-turn from Barclays on this. Petitions raise the profile, but sometimes doesn't change the direction of a government, or in this case, the bank, that it will go. And it looks as though Barclays has weighed up the pros and cons and have decided the cons outweigh the pros of its remittance services in Somalia.
Hirmoge, if, of course, Barclays does proceed with its current plan, what alternatives do the 40% that you referred to earlier have for getting money from abroad?
Rama, the alternatives are quite limited, but one of them is to get a substitute for Barclays and other multinational financial institutions that will accept deposits and will, of course, ease the conditions that Barclays has put in place. Quite honestly, that's unlikely. Another option is to register the Habshil and other financial institutions abroad as commercial entities so that they'll be able to do bank-to-bank transfer between abroad, that is Europe and America mainly, and Somalia. But that again will weigh heavily on the remote areas because the Hawalas have been everywhere in this country offering quite effective and efficient service of money remittances. But we also know that there are fears that should Barclays Bank make good the threat to close the 250 accounts of the Hawalas, then the business might still go underground and operate illegally, and that will actually pose the threat, the grave danger of not being able to monitor the source of the money or where the money ends up. Therefore, it's quite a catch-22 over here.
Indeed. Finally, Melanie, Barclays has argued repeatedly that this decision is about mitigating the risk of money laundering and terror financing, but usually they just leave it at that. What specific lack of controls among these small firms are they really spooked about?
Well, the problem is banks are coming under more and more pressure to streamline their services. Could not guarantee that they weren't unwittingly financing money and laundering and terror financing, and some analysts needed to be put in place could just become too costly for Barclays, both in monetary terms and within their regulatory compliance. Banks are becoming less global as they face tough regulatory demands, and we've seen a number of banks pull back on operations in emerging economies as international money laundering rules tighten. As ever with cost cutting, someone usually pays a big price for it. In this case, it's likely to hurt the already fragile nation and economy of Somalia.
Indeed. We'll have to leave it there for the time being. Thank you very much for your insights. CCTV's Mohammed Hirmoge in Mogadishu and Melanie Ralph over in London. Let's make a quick run through the African markets now, see exactly what your money has been doing on Monday. Most of the markets opened broadly positively, except, however, for our friends over in Nigeria. The all-share index ending the day down by just about 0.6. The all-share index in South Africa, however, in the green, up 1.3%. The 20-share index in the Kenyan capital also in the green. Some fairly interesting stories happening around the currency, however. At about 87.70, you're looking at about a 4-month low, give or take. And of course, government financing costs have shot up quite a bit. Yields on the 92-day T-bills around 10%, give or take. And of course, Egyptian market also in the green, up by 0.39 percentage points. Now, onto the sports with Beatrice.